I thought we'd start off with a super basic question. And my question was, hey, Marc, what's digital infrastructure? And I say it's super basic because I feel like we kind of know what it is, but I want to get your definition.
Well, I said, hey, Alix, it's the picks and the shovels, and it's essential plumbing to what makes AI and cloud computing and mobility work. So really, we provide the mission-critical infrastructure that enables mobile networks, really cloud computing, large enterprises, and all of the things that enable the digital economy today require that plumbing or that transport.
So if I was asking you this question 10 years ago, what would your answer be versus today?
That's a great question. I would say 10 years ago, we were pretty focused on building LTE networks and bringing that fiber connectivity to cell towers to provide the speed at which LTE was transmitting mobile data.
So it makes my phone faster.
Make your phone faster, make it more ubiquitous, and continue to provide a level of service to the customers where they could continue to proliferate their networks at that time.
And what would you say now?
I would say today we're really about enabling not only cloud and applications to the edge, but I think in AI we're really building kind of the next generation of infrastructure that'll power really compute, applications, consumer, enterprise, government agencies, machine-to-machine connectivity. The sort of paradigm shift in infrastructure today is, of course, at every iteration, it's build more, build it faster, and make it more ubiquitous. And I think that's the challenge we face today.
When Marc and I were talking offline, he was making a great comparison of the cloud and sort of the revolution in cloud and then where we are with that revolution in AI. Can you just walk me through that thinking? Because you played in the cloud, you've been doing this a long time. Where are we?
Well, I think, I like to think about these tectonic shifts in kind of 10-year iterations. I think when we started, building mobile networks in 1994, I thought that was a 10-year mission we were on. It turns out that's turned out to be a 30-year mission in building that infrastructure. When we were wiring up office buildings with high-speed internet here in New York City in 1998, 99, I thought the internet boom was a 10-year iteration. And I think as we look backwards and we look at public cloud, we started building cloud infrastructure in 2011. And ultimately, those applications became commercialized in, call it 2013 to 2016, really somewhat ubiquitous on your mobile device in 2016. And that's really when the public cloud companies began to monetize cloud and applications. I really think that AI sort of follows a very similar arc in terms of where public cloud goes. We've been building AI now for about 3 years. I think we're sort of, if we were playing kind of a 9-inning baseball game, we're sort of in the second inning, maybe third inning. But keep in mind, we're still building large language models. And those data centers are big and complicated. And there's a series of host of challenges which we can talk about. And then we start moving into inference in the next 24 months. And that's where really the power of AI, like Michael said previously, gets more interesting. When you're building inference, it's a lot like the proliferation of the public cloud, and so that should be another 7 to 8 years of CapEx spending, because even today, we're still building public cloud to the edge. Edge computing is a huge part of our business today. We've got really important businesses like Atlas Edge, DataBank, and AIMS in Southeast Asia, where we're building those critical workloads in the secondary and tertiary markets that really enable compute to work at the edge.
When you mean at the edge, you mean like over there? Like
physically, right over there, the edge.
Okay,
it's
meaning
right over
that
there.
Like if I have AI on my phone, it's going to work a lot better if it's right over there.
100%. Latency is really the bottleneck in enabling compute to move quickly and to move fast and to ultimately work for that specific application or that enterprise or that government agency. So today, public cloud is on the edge. A lot of the workloads that are being built for public cloud today sit in tier 2 and tier 3 markets. So really sexy markets like Bluffdale, Utah, Overland Park, Kansas City. Woo, I know, I tell you, you're getting excited.
I'm from New York.
These secondary and tertiary markets are where those 5 megawatt and 10 megawatt leases are being signed for cloud at the edge. Inference will take a very similar blueprint and follow where public cloud went. And so this investment cycle we're in is not for the next 2 or 3 years. I tell our LPs, if you're going to invest in artificial intelligence infrastructure, be prepared to be investing for the next 10 years.
And what makes you guys really cool is you guys really build the stuff. You're not partnering, you're not taking a junior stake in another company, like you're the guys putting in the wires.
That's been our DNA. For us, it started, again, in 1994, we built our first cell towers. That was the journey for us. And today, we not only build data centers, but we build edge data centers, private cloud, public cloud, enterprise-grade data centers. And then, of course, we're building everything related to that. And that's the connectivity piece. So fiber optics are a really important part of delivering AI, and our businesses that provide that dark fiber, that conduit, and that connectivity is just as important as building the data center. And then the mobile infrastructure is growing at an incredibly fast clip as well. We're still in the early innings of building 5G. We're now kind of in the second phase of 5G infrastructure, which is what we call infill. And so as you saw probably from the earnings calls of AT&T, Verizon, and T-Mobile, they've all upped their CapEx for 25. Why? Because now 5G is being monetized, and there's other applications that are coming. So we're really busy. I mean, mobility, cloud, connectivity, all of these things enable the economy. And so, you know, at DigitalBridge, when we reported earnings 2 weeks ago, we actually have just recently, we're just up against about 100 billion of assets. Go back 5 years ago, we were at about 22 billion of assets under management. We've grown our business almost 5x in the last 5 years. So we've been incredibly busy, as you said, acquiring land, getting permits, getting will-serve letters, dealing with supply chain issues, but really with a core focus on delivering for our customers.
You set me up for that. Did your job just get a lot harder today, considering all the tariff news and stuff?
I think, you know, tariffs are a narrative. I don't think tariffs are a reality.
Okay.
In our industry, at least. I mean, we've built a supply chain over the last, you know, decade to prepare for ourselves and to enable what we're doing. I think a lot of our portfolio companies, we own 51 companies around the world today. A lot of our portfolio companies are very prepared. We help prepare them. A lot of the purchasing that we do, for example, at Zayo, which is the largest long-haul fiber network in the US, it's one of our companies. We started buying fiber from Corning in mass bulk 5 years ago at the beginning of COVID. So we really felt like there was this massive data tsunami coming in terms of connectivity to cloud and to AI. And so Steve Smith and I made a decision that we were going to go out and really over-purchase on Corning, and that's what we did. So we locked up a lot of fiber, and while other institutions maybe have had challenges getting fiber, we didn't. We sort of predicted the amount of data that was coming, and so we purchased in advance of that. Same thing at Vantage, our hyperscale data center operator. We developed a great partnership with Siemens 5 years ago. We knew gensets were going to be super important to enable cloud computing and AI, so we created a partnership with Siemens, and we bought a lot of gensets 5 years ago. We got out in front of that before it became a real problem. So I don't know where tariffs go yet. I think you and I were talking about it earlier. I think it's early innings in terms of what the impact will be. The only area where I see tariffs impacting sort of AI infrastructure is really in and around specialized componentry.
Okay.
And data centers do have specialized componentries that comes from places like Taiwan, Korea, Germany. You know, these are absolute countries that are within the purview of what the president was talking about last night. So we'll have to see where the dust settles. A lot of discussion around, you know, leveling the playing field. But I also know that this administration really appreciates the race for AI.
Right.
He's made that a priority. The president talking last night about Oracle and Masa and Sam, he gets it. I think he understands the most important part of what we're doing is we are in an arms race. And I think we want to stay out in front of that. We don't want to fall behind it. So the hope is we can have a constructive dialogue with the White House and explain as an industry why some of this specialized componentry is going to enable America to stay first. Let's
play the fun game. Let's just pretend for a second that you do get tariffs on specialized components, right?
Yes.
I'm interested in what part of your job gets harder. Does it make it more time constrained? Like, do your projects get pushed out on a time level? Do they cost more? Do the contracts that you enter in become more difficult to come to an agreement?
So I think all three things are true.
Okay.
I think first and foremost, we have delays already. Supply chain is impacting our ability to deliver, you know, data halls on time, which allow our customers to move their servers in. There's delays with GPUs. NVIDIA is super backed up in terms of their delivery for their core customers. And so that's an issue too, that once we deliver the data hall, we turn over to hyperscaler A and we say, here you go, here's your data hall, move in. And they're like, well, we'd really like to, but we don't have the GPUs. And so I think that is an issue. I think that is a bottleneck that kind of clears itself up in 12 to 36 months, where you'll see a more normal cadence in terms of delivery. I think the other issue you talk about is just the cost side of it. Really, we felt the pain of cost in COVID. Inflation really impacted our cost of construction. So if you look at, fiber route per mile during that sort of 5-year period went up about 20%. And it wasn't Corning, it was actually the labor. So to trench a fiber route from Northern Virginia to Columbus, Ohio, which has turned out to be one of the really hot routes right now in fiber, it wasn't so much that we didn't have the cables, it was finding the right labor. And labor costs went way up because there isn't exactly a dearth of ditch diggers. So that's a specialized form of talent, specialized form of engineering, more cost. Cell towers, if you go back 5 years ago, an average cell tower would cost us on average about $190,000 to $210,000 to build. Today, an average cell tower costs somewhere between $275,000 and $325,000.
Wow.
So again, that was steel cost, specialized componentry, labor. Labor has gone way up in our industry. And then the same thing in data centers. Data center costs have moved up. We could build a megawatt 5 years ago for $7.5 to $9 million. Today, a megawatt costs between $8 and $11 million to deliver for customers. So we really felt that pain, and it was more inflationary than it is tariffs. But I think what you're seeing today is really a landscape where everything does cost more, which gets to the third point, which is the conversation with the customer. And just sitting with customers and resetting some of those relationships. And we've been doing this for 30 years. So I've had these moments where we've had to sit down with customers and say, look, this is costing us more. You know it. We know it. We're good partners. We've been partners for decades. We need more rent. And so then begins the negotiation. And so we've had constructive conversations with our customers. Look, at the end of the day, the reality is most of our customers don't want to self-perform. Their balance sheets aren't equipped to self-perform. Not everybody has the balance sheet that Microsoft or Amazon has. And so there is an admission by our customers that they want partnership, they want collaboration. So when we're sitting with Hans at Verizon, it's a great partnership. And he works with us and we work with his team and we get to the right place. We just bought 7,000 towers from Verizon back in December. So we've had these long-lived relationships that are decades and going. And I've always told many of my my partners that, look, the most important thing with a customer is to be transparent and be quick. Don't be slow when there's a pricing discussion to be had. If there's bad news to share it with your customer fast.
There's a question from the audience, and this talks about that edge. I want to talk more about the expansion on the edge. Is it from the core to the edge, or is there an intermediate step? And so if I understand that correctly, it means like here's where the big stuff is, and here's where the city is. Is there something in
There is actually. So the core of the network is really what they call, for example, if you're dealing with AWS or Microsoft, they'll have something that's called a primary AZ. And AZ is an availability zone, which is where they put a lot of their compute. From that AZ, you'll move out, which are in primary markets, primary markets being Santa Clara, Goodyear, Arizona, Dallas, Texas is a primary node, Atlanta, Georgia is a primary node, Northern Virginia, of course, is the biggest presence of data centers in the US. And then you kind of move out to edge. And those edge markets are the next sort of layer, which would be in Austin, Texas, it'd be a Houston, we talked about Overland Park. And so that is edge compute. And then we have something that's actually called near edge. And near edge is actually where you build these, what we call sort of RAN hubs or edge data centers like near edge. And so there what we're doing is we're taking former central offices owned by the Bell companies, or we're taking a cable head-end feed that has generators, that has power, that has fiber, but it's a smaller building. So imagine it's a building that's 5,000 to 10,000 square feet. I'm not putting 100 megawatts into that facility. I'm actually putting in anywhere from 100 kW to 250 kW, and I'm stacking anywhere from 4 to 20 racks. That's near edge. So that's literally in the suburbs. So really pushing the compute to the periphery of the network. And then ultimately we think sort of micro edge will be at the cell tower, where maybe there's a software-defined component to the radio, where you're connecting to Netflix, you're connecting to Amazon, and you're actually providing that service adjacent to the radio, which will all be software-defined. So there's actually 4 layers to where networks are going today.
I could talk to you for like 25 more minutes, but we only have 5. So I wanted to get to the liquidity issue here. So I was struck by Dawn Fitzpatrick yesterday at Soros Fund Management. She was saying that she's very hesitant for private markets because she really wants the liquidity. That's why she's staying in public markets. How do you provide liquidity when you're spending lots of money building all this stuff out?
It's an interesting conversation we have with LPs, and by the way, 100% correct. The market is, in illiquids, it is by nature illiquid. And so when you're in the alternative asset management space like we are, we're in the infrastructure space. Most of our funds, Alix, are 11 to 13-year fund duration. But that being said, we have to create liquidity. This is a market where LPs demand liquidity. So the number one question that I get on the road fundraising is, how are we doing on DPI? Tell me how Fund 1 is, tell me how Fund 2 is, Fund 3, explain your vintage and explain your DPI. So we've been really focused on that. So we said on our earnings call 2 weeks ago, we've delivered about $9 billion of DPI in the last 2 years, a little over the last 2 years. And we've had 8 different exits. And the other question then we get from LPs is, well, how do you generate that liquidity? And we said, well, it's really simple. You have to be very creative. Michael mentioned before me IPOs. IPOs were really not present in the last 5 years. So we took that off the playing field. Now that's coming back into the playing field. But continuation funds have worked really well for us, where we partner with an insurance company or an allocator that really wants access to a great platform or a great product. We did that with DataBank and Swiss Life. That worked out really well. We created billions of dollars of liquidity for investors there. We've done recaps. So dividend recaps where we work with an LP that really likes an asset. So whether it's a big sovereign wealth fund or a big LP, if there's a platform inside of one of our funds that makes a lot of sense for them and they want it to be a long-term hold, we'll go and run a process, and that process will ultimately create a value, and then they'll buy 80% of that platform and demand that we stay in for 20% and that we roll our carried interest back into the vehicle. So continuation funds, sales to other LPs, and then of course sales to other infrastructure GPs. We work with a lot of the other GPs. You know, we've sold assets to GIP, we've sold assets to KKR, we've sold assets to Antin. And so I think today in this environment, with strategics kind of being on the sidelines and IPOs being now coming back in, we've had to be a little more creative in how we structure the liquidity. But at the end of the day, DPI is DPI. So we were happy to deliver $9 billion in DPI, and it's now allowed us to go back out and ask for more capital. So we are returning capital right now. It is part of our mandate, but at the same time, we're also raising a lot of capital.
You guys also securitized fiber optic cables, right?
Yes.
I don't get that. What does that mean? How did it go?
Well, I think asset-backed securitization is really has found a nice home in digital infrastructure. I did my first cell tower securitization in 2003, and what I figured out is my background was real estate, and ultimately we had ground leases and we owned land. So we figured out that we could put mortgages on cell towers. And then what I did is by having thousands of mortgages on cell towers, I could collateralize them in a pool and I could sell them into a CMBS structure. We thought it was risky at the time. It's worked out pretty well. All 3 public tower companies now use CMBS as the primary mechanism to finance American Tower, Crown, and SBA. This securitization that you mentioned was our 53rd securitization that we've done as a firm. We've accessed over $30 billion of institutional capital because really institutional investors love the long-term nature of digital infrastructure. Most of our leases on a cell tower are 25 years. Our data center leases are 15 years. A long-haul fiber route IRU is 30 to 50 years. So we have really long-term visibility in our cash flows. And oh, by the way, greater than 65% of our cash flows are investment grade. So it really sets up well for either an ABS or a CMBS. Data center CMBS is where we own the land. Cell tower CMBS is where we own the land. And then ABS is on a fiber route. So think of a fiber route. If you take a long stretch of conduit from New York City all the way out to, let's go back to Northern Virginia again, Data Center Alley, and you take that fiber route, and inside that fiber route, Alix, I have 24 pairs of dark fiber. So think of that as 24 unique floors in an office building, flipped on its side. And instead of leasing to a law firm or an accounting firm, guess who you're leasing to? Google, Amazon, Microsoft. And each one of those pairs, you can sell them on that unique route because your route is super unique and it's low latency.
And I'm paying you no matter what.
And you're paying me no matter what.
Okay.
And so you're signing a 20 to 30 year contract with me. We look across the other side of the table and we see Moody's and Fitch and S&P and they're salivating. Why? Because it's investment grade and it's 30 years of cash flows. Really easy to rate a deal like that. So we decided to start securitizing Zayo's fiber routes. The deal was 28 times oversubscribed. We raised $1.4 billion in 10 days. We tightened that transaction 6 times. I've never tightened a securitization 6 times. We got it super tight and it was well executed.